Good morning, this is Tim McGowan for the Finance News Network. Stocks fell Monday as social unrest from China's prolonged COVID restrictions weighed heavily on markets. Protests across China shook up global markets over the last 24 hours, with concerns authorities will take longer to reopen the world's second largest economy. Thousands took to the streets in the biggest challenge to the authority of the Chinese Communist Party in years. Censors have moved quickly to scrub photos and video footage of the protests. Of course, the China reopening hope was part of the bullish end-of-year narrative for markets. That now appears to have turned into something more serious for markets to worry about. Ironically, US-listed Chinese stocks all performed strongly overnight relative to indexes. This week, investors will eye a raft of economic data that will offer further information on the state of the US economy. Key releases include Thursday's Personal Consumption Expenditures Report, a key inflation measure for the Fed Reserve, and November's payroll report scheduled for Friday. Overnight, the Dow Jones Industrial Average lost 1.5%, the S&P and Nasdaq shed around 1.5% themselves. The developments in China reverberated across global markets, with West Texas crude futures briefly dipping to their lowest price since last December. Overnight, shares of companies with big production facilities in the country were under pressure. Apple dropped 2.8% after Bloomberg reported that unrest at a factory in China could mean 6 million fewer iPhone Pro units for the year. Apple's iPhone supply chain could be hit hard as more than 20,000 employees have reportedly quit Foxconn's main iPhone plant in China due to concerns about COVID and other workplace issues. Most sectors fell today amid fairly broad-based weakness. Defensives outperformed, with the likes of Merck, Walmart, Johnson & Johnson, Target and Coca-Cola up on the day. Energy was weak across the board, despite crude recovering from early lows. No commodity has been impacted more heavily than the oil price over the last 2 years, with the oil price moving from one extreme to another. And it appears that the commodity is ripe for more volatility as China COVID restrictions, the Ukraine war, the Russian price cap and the fear of a recession all weigh heavily on its pricing. And in the world of venture capital, workforce analytics, productivity tracking, employee monitoring software, whatever you want to call it, worker surveillance tech investment is trending way up. Pre-pandemic, just 3 in 10 companies with 1,000+ workers used tech to measure employee productivity. But by the end of 2021, 6 in 10 would report doing so. That growth is reflected in funding too. Despite overall VC funding being down in the first 3 quarters of 2022, the sector's total VC investment has surpassed $394 million, or 62% more than 2021's full year total, even though the year is not yet over. The sector's growth in usage and funding comes alongside the rise of fully or semi-remote work, which could make employers more nervous about workforce productivity. On the ASX today, the SPI futures are pointing to a flat start. This is Tim McGowan for Finance News Network. Have a great day.